In the first quarter of 2026, a Chinese memory chip company filed a document that contained a number so large it stopped analysts mid-sentence. Roughly 24.76 billion RMB in net profit accumulated in a single reporting period, erasing approximately a decade of accumulated losses in one line item. Arriving the same season its initial public offering application cleared the STAR Market Review Board. The bullish side calls this proof of life. A state-backed semiconductor project that was supposed to bleed indefinitely just printed the biggest quarterly profit in its history and passed regulatory listing scrutiny. The skeptical side calls it a photograph of high tide. 3 rounds settle which reading survives the cross-examination, the profit claim, the momentum claim, and the cyclicality challenge that the first 2 rounds cannot answer alone. The restriction that was supposed to strand this company at outdated process nodes forced it to compete on price and volume in the segment Samsung and SK Hynix were quietly withdrawing from. That repositioning, not the profit number itself, is the contested question that 1 quarter of extraordinary earnings forces back onto the table. The rounds run in order. The profit as Exhibit 1, the revenue guidance as Exhibit 2, and the market cycle as the evidence that reframes both. Start with the profit. 24.76 billion RMB in net profit is not an accounting footnote. Across most of CXMT's operating history, the company absorbed losses that, in aggregate, represent years of research and development spending, fabrication plant construction, and yield losses as the manufacturing process matured. That a single quarter reversed the entire accumulated deficit signals, something structural or something cosmetic. And those 2 possibilities are not distinguishable from the headline number alone. What the headline does establish is this. The figure appears in a STAR Market initial public offering prospectus, a document subjected to exchange-level regulatory review before listing approval was granted. A company that cannot demonstrate a credible path to profitability does not clear that review. The profit is in the filing. The filing cleared scrutiny. On those facts alone, CXMT is a functioning DRAM business, not a shell drawing down state capital with nothing to show for it. The counterclaim is definitional, and it is sharper than it sounds. What is actually inside that profit number? DRAM manufacturers operating under Chinese industrial policy do so with structural support, low-interest loans, land grants, subsidized utilities, and in some cases direct capital from state-linked investment funds. If a portion of that RMB 24.76 billion reflects the recognition of previously deferred subsidies, asset revaluations, or non-recurring items rather than margin on chips shipped and paid for by customers, then what the filing contains is a restructured balance sheet, not a cash-generative business producing revenue from product. The 2 look identical in a headline. They are not identical in a discounted cash flow model. Regulatory review by Chinese exchange authorities is rigorous on process, but it does not constitute the same independent scrutiny as a public audit by a firm that answers to international accounting standards and institutional investors. No independent line item breakdown of the Q1 2026 net profit has been publicly reported at the time of this analysis. The profit is real in the filing. Its economic content is the open question. The round turns on what the court accepts as evidence. The filed number is a real exhibit. The challenge to its composition is a legitimate inference, but it is an inference without documentary support, and inferences do not overturn filed numbers without more. Round 1 goes to the bullish side, narrowly. The skeptical challenge to profit composition is noted, preserved for later rounds, and remains unresolved. The second exhibit is more operationally revealing than the profit number, because it comes with a direction and a rate. CXMT guided first half 2026 revenue at roughly 613 to 677% above the same period a year earlier. A guidance range of that magnitude, even discounted as forward-looking and unaudited, cannot be explained by price movement alone. A memory upcycle lifts average selling prices for every producer in the market simultaneously. Samsung, SK Hynix, Micron, and CXMT alike. Everyone benefits from a price recovery, but a 613% year-over-year revenue surge implies that volume is moving alongside price. Volume means wafer starts at scale. It means yields that are good enough to ship product that customers will accept. It means buyers willing to qualify CXMT product into their supply chains, a process that typically takes months of testing and validation. It means a logistics and support infrastructure that can execute at commercial scale. If that guidance range is even directionally accurate, CXMT is not a pilot line running demonstration quantities for friendly customers. It is a volume producer capturing real market share in a segment where share has been locked up by the Korean duopoly and Micron for decades. The counter to the guidance is base effects, and the math is worth spelling out. 613% growth off a very small base is arithmetically very different from 613% growth off a material one. CXMT was deeply loss-making through most of its operating life, which implies a revenue base that was constrained. If first half 2025 revenue was small enough, the percentage growth is dramatic, without the absolute number being large enough to represent meaningful market share. Samsung's DRAM revenue in a single quarter dwarfs what CXMT's annual guidance implies. Momentum and market power are different claims, and percentage growth on a small base proves only the first. There is also the gap between guidance and result. Fab utilization rates, customer order cancellations, and price resets can compress semiconductor revenue sharply between a guidance date and a reporting date. Guidance is a promise. The market scores promises on delivery. The round is a genuine contest. Explosive percentage growth is evidence of operational traction even after base effect adjustment, because tripling or quadrupling any number still requires machinery that runs, yields that clear shipping thresholds, and customers who place orders and pay invoices. That is not nothing. But the base effect caveat is legitimate and keeps this from being a decisive round. Round 2 goes to the bullish side, again narrowly, and with a smaller margin than round 1. Guidance confirmed by first half actuals would reopen this round at a higher evidentiary standard. For now, guidance alone earns the round but does not close the argument. Think of DRAM pricing as a tide. Every manufacturer on the beach profits when the tide comes in. Their inventory is worth more. Their older product clears. Their quarterly numbers look remarkable. Samsung is built on a cliff. SK Hynix is on elevated ground. CXMT, based on current reporting, is on the sand. The tide came in. The question the skeptical side is asking is not whether CXMT benefited from rising water. It is where the company will be standing when the tide goes back out. DRAM is the most cyclically violent market in the technology supply chain. Prices move faster and further in both directions than almost any other component category. A decade of losses wiped in one quarter is not proof of structural profitability. It is the signature pattern of a cyclical peak. The same arithmetic that makes the profit spectacular on the way up will make the next loss quarter spectacular on the way down, because CXMT's cost structure has not been independently confirmed to be competitive with Samsung's or SK Hynix's at the process nodes, where the competition for margin is actually decided. The Korean manufacturers and Micron have spent decades optimizing cost per bit at the most advanced nodes available. They carry the capacity to drop prices in a downturn and remain profitable, using margin compression as a competitive weapon against a challenger whose cost base is higher and whose process technology reports suggest lags by at least a generation. A challenger at a process disadvantage competing during an industry upcycle is in the strongest position it will see until the next upcycle. The incumbents know this. Their strategic response to a downturn is to compress margins toward the challenger's cost floor and wait. The cyclicality argument is the strongest single exhibit in the skeptical case, because it does not require proving the profit is false or the guidance is fabricated. It only requires demonstrating that the profit is insufficient evidence of structural competitiveness. That is a lower evidentiary bar, and the skeptics clear it without difficulty. Round 3 goes to the skeptics. The ruling is not that CXMT failed. It is that one quarter is not enough evidence to call the fight. The decisive exhibit in this case is not the profit number and not the guidance range. It is what the prospectus does not yet show. DRAM competition is actually decided on 3 figures: cost per bit, process node generation, and yield rates at volume production. Those 3 figures determine whether a manufacturer can hold margin when prices fall, whether it can execute a node transition without catastrophic yield loss across millions of wafers, and whether its product can be qualified into supply chains that currently source exclusively from Samsung or SK Hynix. None of those figures are independently confirmed in public sources at the time of this analysis. The company's own claims in a prospectus are the best available source, and prospectus claims are written by parties with a direct interest in the strongest possible presentation of the business. The court is being asked to rule on a turnaround based on 1 quarter of financials and 1 set of forward guidance, without the cost structure data that would make the ruling sound. 3 points weigh against the verdict that follows, and all 3 deserve naming before the gavel drops. The verdict could be wrong if the profit composition is confirmed by an independent audit to be almost entirely operating income from chip sales at competitive margins, not subsidy recognition or balance sheet restructuring. If that confirmation arrives with full prospectus disclosure, the bullish case gains significantly more weight. That confirmation does not exist at this time. The verdict could be wrong if first half 2026 actuals, when reported, confirm the guidance range. Actual revenue at the high end of a 613 to 677% guidance range, combined with maintained profitability, would be evidence of sustained operational execution rather than a 1 quarter spike. First half actuals are not yet reported. The court does not rule on future evidence. The verdict could be wrong if CXMT's process node position is closer to Samsung's and SK Hynix's than trade press accounts currently suggest, if the node gap is smaller than reported, or if advances not yet publicly disclosed have been made, the cost per bit disadvantage narrows and the cyclicality argument weakens. Node generation claims from CXMT are the company's own assertions. No independent third-party benchmark confirms the specific process node or the yield rates at volume production. And even with an optimistic node estimate, physical scaling in DRAM faces heat dissipation and capacitor geometry constraints that the entire industry is navigating simultaneously. CXMT's path to the next node is not uniquely obstructed by export restriction. It is constrained by the same physics that constrain Samsung. But it arrives at that constraint with fewer process generations of accumulated learning, a smaller installed base of qualified customers, and a balance sheet that carries the recent memory of a decade of losses. The 3 dissent points share a structure. Each one is a future fact that could upgrade the ruling, not a current fact that overturns it. The analyst who mistakes a forecast for a ruling loses credibility faster than the analyst who waits for the next filing. The scorecard reads 2 rounds to 1 in favor of the bullish case. The profit is real in the filing. The guidance is real as guidance. Both facts matter, but the skeptics take the decisive round. And the decisive round is the one that determines whether this contest is over or whether it has only just found its real question. CXMT passed the STAR Market Review. CXMT posted the profit. CXMT guided revenue at a number that, if confirmed, would mark a genuine operational inflection. None of that is in dispute. What is in dispute is whether any of it means CXMT has closed the structural gap with Samsung and SK Hynix. The gap in process nodes, in cost per bit, in the depth of customer qualification, and in the capacity to survive a downturn without state support filling the breach. On that question, the evidence available is 1 quarter of financials, 1 guidance range, and a prospectus that has not yet disclosed its cost structure in independently verifiable form. CXMT has demonstrated survival and cyclical execution. It has not yet demonstrated competitive parity. Those are different achievements, and the specific error the profit headline invites is treating them as the same. The restriction that was supposed to strand CXMT at legacy nodes did strand it, and that stranding forced it into the low-end, high-volume DRAM segment that Samsung and SK Hynix were quietly withdrawing capital from, redirecting investment toward high-bandwidth memory and leading-edge mobile DRAM for premium device makers. CXMT's first quarter 2026 profit is partly a statement about its own execution and partly a statement about where the incumbents decided not to compete. The restriction reopened the question it was intended to close, not by failing, but by redirecting competition into the one segment where a constrained challenger could accumulate volume, develop customer relationships, and survive long enough to reach an upcycle with product that could ship at scale. That initial public offering prospectus, the same document that carries the profit number, the guidance range, and the regulatory stamp of STAR Market clearance, is the most consequential filing in Chinese memory manufacturing history, precisely because it cannot yet answer its own most important question. CXMT is in the dock. The verdict on this quarter is survival and cyclical competence. The verdict on the decade is still being written. One quarter proves a company can print money. It does not prove the press will keep running. Which round did the judge score wrong? If round 2 belongs to the skeptics, because guidance on a small base is not evidence of momentum, but arithmetic, make that case. If round 3 belongs to the bullish side, because surviving a prolonged down cycle on state support and converting that patience into an upcycle profit is exactly what a rational long-horizon industrial strategy looks like, the argument is welcome. The score is 2-1. Put the dissent on the record below. Subscribe for the next filing. When first half actuals come in, round 2 gets scored again with real numbers, and the verdict moves.